Realty Income then, so the opposite of Teladoc, basically. Friend of dividend investors anywhere, reported its earnings this week, and they were pretty uninteresting, but I think they were kind of sneak better than I was expecting them to be. So their revenue for the quarter came in at $889 million, which was 30% higher than it was this quarter last year. Adjusted funds from operations for the quarter were $1, which was 6% higher than last year. Revenue for the full year, because it was the end of the year, came in at $3.3 billion, up about 35%, and adjusted funds from operations $3.92. The stock has a price of around the 65 region. I'm moving around at the moment because the market's open. So this is a company then that attempts to focus on high quality tenants that are unlikely to go bust, unlikely to not pay their rent, and generally give you much better sleeping nights than Cathy Wood's having it with Teladoc. So that has its puts and takes, to be honest. It's very obvious what the kind of good news is with that. So you'll get better occupancy rates, you'll get better rent collections, unlikely that much is going to go wrong, with one exception that we'll come back to in a moment. And occupancy was good this quarter. It was 99.2%. Cool. Same store rent was basically flat, so they had some small gains which were offset by Cineworld going bankrupt. They hope to recover the money that they should have got in rent from Cineworld and whatever they're called, Regency or Regal or something, cinemas. But that meant that overall things were flat compared to last year in terms of same store rent. That's the kind of downside with something like Realty Income. If you have high quality tenants, they're unlikely to let you rip them off because they're high quality tenants and they can go somewhere else. And Realty Income is, generally speaking, a pretty undifferentiated operation. So if you think about that compared to something like a Federal Realty, which focuses on high quality locations, and you can't just run away and get something similar elsewhere, there's less obviously a point of differentiation here. So that makes them kind of, in some ways, price takers rather than price setters. I think their average rent escalator per year is about 1%. So you're not going to get huge amounts of growth there, certainly nothing that's going to outpace inflation at 2%. Even if it gets to 2%, which it's currently not, it's miles higher. What that means then is they have to try and stay ahead of things by acquiring things and disposing of things and somehow getting more properties and renting them out better. And that comes with challenges in a rising interest rate. So they raised in the last quarter $2.2 billion with an equity placement at around $65, which means basically the idea with these is that you want to try and raise money at one price and then invest it in something that's going to pay you rent at a higher price. It's kind of as simple as that for Realty Income. And if you think about what that cost them then to raise at 65, well, they have a dividend which currently is a 4.5% yield there, so call it 4.5% they need to get above. And they raised $750 million in debt at just under 4%. So they're looking to kind of get a return there. Anything above whatever the weighted average of that is, probably about 4.3%. Anything above that as a return is going to put them ahead. Anything below that is going to put them behind. And their basic plan is to try and grow by doing that. And the real question about this business is how often can you repeat that trick of issuing debt or equity at one price and then finding something to buy at another one. You can also do it by disposing of properties that you have and then trying to find better ones and renting them out like that. But that incurs costs along the way. So the guidance for next year is $5 billion in acquisitions. They reckon they can keep doing this, which is kind of encouraging. Same store rent growth, they're looking for what they call above 1.25%, which is not that high. Adjusted funds from operations, somewhere around the $4 mark. In their words, our external growth opportunities are broad, including diverse property types and geographies. I'm not sure I believe that particularly. I think the opportunities for them are getting narrower and narrower, and they're getting harder and harder as interest rates are going up because their debt's getting more expensive and their ability to grow this is going to become an issue. I'm not that worried about the debt that they have at the moment in their existing stuff. I think they'll be fine with that, but I am getting slightly concerned by their ability to grow their portfolio by taking on debt and then finding a better opportunity to go and invest it again. And I think that's coming through a little bit in their numbers for their dividend. So everything you look at in their investor presentation talks about their CAGR over time, and it's all since their 1994 listing. And that was a long time ago. They point out they've managed to grow this at 4.4% per year since 1994. And it's true, by the way. I'm not saying they're making that up. But that's a long time ago. Their 5-year CAGR on their dividend is 1.75%. So this thing is growing much slower. My general takeaway from all of this is that you can buy the thing today if you want. It's got a yield of about 4.6%. I think at some stage that external growth will slow down and what you'll be left with is a low internal growth story. If you think that's a big enough yield to be worth it to you, and probably significantly lower risk than something like Teladoc, fine. Absolutely no problem with buying the stock at that level. But I think if I were a dividend investor, which I'm not, but I do own this, I would be thinking that there are definitely puts and takes to this rather than just a long dividend history and some successive dividend increases. It's not, to me, the obvious kind of goldmine that dividend investors think it is. I think there's genuine risk there that it's worth being aware of. What do you think, Steve? That was quite long.
Well, so with a REIT, I generally think the master plan must be to acquire until you can acquire no more, and then start to raise the prices incrementally on people, and that's how you then generate your growth from that period forward. Realty Income is a large scale now. It's at a scale where it stopped acquiring properties and it started acquiring companies, and in so doing that, it's had to spin off another company. It was Orion, wasn't it? Was it last year or the year before that? I think I'd have almost preferred to have seen that kept inside if they could have done, but there we go. So yeah, you're definitely right. I nodded and said yes, even though I forgot I was on mute when you said about the dividend. You can definitely see that, and you can really see there's that real struggle to keep cranking up that dividend. They're managing it, but yeah, a real struggle, which is going to end up being quite embarrassing if they ever have to cut this or not grow it, considering they've trademarked the monthly dividend company as their slogan. So yeah, I mean, I really like Realty Income. I think it was one of the first companies I must have put you on to when me and you first started talking about investing in it. It was one of those stocks that I said it's just worth a look at. It's just a fantastically well managed REIT and has been for a very long time. But it might be getting to what I think you're trying to point out is maybe the sort of peak of its abilities at the moment. I think it's potentially running out of properties that it can buy at a good price that will move the needle for them, and that's a real problem for REIT. And it won't just be Realty Income alone that suffers with this. All of the other REITs will eventually encounter something like this, especially as the rates continue to increase, and with the inflation numbers coming in a little bit hot today, that sort of heightens the chances of a heavier lift in interest rates, which only sort of compounds on this problem for us. So Realty Income, they're a great stock if you just want income, but if you want that income to grow pretty quickly or to increase every year from this point forwards, I'd be less inclined to be looking at it.
That's a pretty good summary, I think. Yeah, I'm looking at this as something that needs to grow externally by acquisition. Acquisitions are getting harder, although I thought the report from this was sort of reasonably encouraging that there's at least another year left to come. And once you get past the stage of external acquisitions, I don't think they have the ability to raise prices very much, because I don't think they have a very differentiated offering, and I think they have tenants who will say, I want to pay higher prices. I'll go somewhere else in that case. I have a really good credit rating. Loads of other places will have me. So I'm sort of thinking of that as the big point of uncertainty is how long can they keep acquiring and keep acquiring well. On the positive side for them, I would back them to not do a Teladoc thing, and I would back them to not acquire badly. I think they probably just wouldn't acquire at all. I don't think they will get to a point where they start desperately reaching to try and keep things growing, because they've got some internal growth if they can keep ticking things over, even at just 1%, and the dividend's not growing much faster than that. I think they have a bunch of shareholders who will be happy as long as the dividend goes up by some amount every pretty much quarter. They tend to increase, but that's sort of where I think I see them, and I thought that was a reasonably encouraging report that there's a bit more left in the acquisition machine.
Yeah, interesting to see. Well, this is one of those things, isn't it? It's almost a bet on the macro environment, isn't it? So if you start acquiring REITs now, you've got to hope that interest rates are coming down, or that your manager is very, very adept at offsetting future rises in interest rates. If we end up at the Volcker level, sort of 20 to 40 interest rates, all of these REITs are screwed. But yeah, interesting one, Steve.